Good morning, everybody. Thank you for spending some time with us. It has been an awful, awful few weeks. Um, Not having fun, but I'm not supposed to have fun. I'm here to work for you. That's what we are doing, working very hard. And I want to go explain to you what's been taking place in the last several weeks. Is a rotation in the market. This market has been trying to rotate from the mega cap stocks into other parts of the market. It tried it in November as we participated. It tried it again in March as we tried to participate, and it's doing it again right now. Whereas the market has been driven, we spoke about this, by 10 stocks primarily. At some point, the market said enough is enough. Let's sell some of those 10 stocks plus anything around it, notably technology, artificial intelligence related, power related, all the stuff that has been working, let's sell that and buy the stuff that hasn't been working. So a huge rotation has been taking place. It's historic, as a matter of fact. I will say it will end. I don't know when. We do have balance in our portfolios. You can just never have enough when it's aggressively shifting as it is. And I don't want to get too caught up in it. I tried that before, and it doesn't always work. So I have to be very conscious of that. I do like the way we are positioned right now, although the market's not totally agreeing with me. That's a different story. So you can see here the sector rotation in this slide. What has turned on, what has turned off by sector. This goes into communication sector. Again, what's driven it in the last 12 months, shall I say, and in specific window. Specific names that caught the attention of the market. Interesting. This is a sector that has been driven again by a few names, but is broadening out. The weight loss drugs has driven the healthcare sector. Big pharma left for dead. It's actually waking up a little bit. MedTech has been challenged, with COVID, hospital closures, backups, supply chain, a whole lot of excuses. And then there's biotech, which is discovery for new drugs, and that's a binary trade. But within the healthcare sector, there are spaces that we are looking at, notably hospitals, private hospitals in the United States. HCA Healthcare is a stock that's screening very, very well. We want to increase the healthcare exposure. We have been underweight healthcare, so we're looking for a few names. We have a few names to purchase. We have to figure out what to sell. And I don't want to give anything away, especially in the downdraft that we just had. This is not a time for to be selling. I will warn you that the market certainly can fall an equal amount further from what it has fallen. We have to brace ourselves for that. Seasonally, we're in the weak period of the market, August and September. We have to be mentally prepared for that. It is temporary. It will end. We are in a bull market. This market is going to push higher. It'll just shake a few of us out along the way. I don't want to be one of those shaken out. Stirred, perhaps, not shaken. But healthcare, we want to build out. Industrials, we have a wonderful position in. Anything from home builders to HVAC systems, electrification. It's working. Will it continue to work? We'll see. The economy continues to move along. It's slowing a little. Interest rates coming down has been the biggest culprit of hurting tech and helping the small cap sector. Interest rates coming down a little bit. I think relatively neutral towards the industrials are not over levered. They're not really levered play on rates, but small caps certainly are. Emerging markets certainly are. S&P 500. This showing you based on what has worked, what's kicked into gear since July 10th. Interesting fact sets. Interest rate cut. This is again a huge driver of what's been moving tech. Good and bad. When rates began to rise 2 years ago, tech got absolutely annihilated. We were super underweight tech. What year was that, Jack?
2022.
2022. Yeah, so we were super light tech, and light and got even lighter. Yes. That really helped us. And then we reloaded tech in 2023. So I go back to interest rate hikes were hurting tech, hurting the bond market. And then the rate cut or the rate hike notion became accepted. The economy wasn't necessarily slowing, but not ripping, and money went back into technology. And then artificial intelligence came to the forefront. And that gave it a wonderful narrative to work off of, which is a real narrative, artificial intelligence. And here we are today. So tech had a shakeout with rising rates. Now rates are falling and tech's getting a shakeout. So tech sold off when rates began to rise. Tech sold off. Now the rates are about to begin to fall. In the middle of it all, tech will do just fine, I believe. It's just this movement from risk on, risk off, growth into value. It will normalize. The question is when and to what degree. But the likelihood of an interest rate cut in America is almost 100% in September. Jack, and some of the economists that we've had on our show this week on Hi-Fi Radio, I encourage you to listen to it. It was actually a very, very good show with two great guests. Our strategist from New York City spent 2 segments with us, and John Johnston, who is my former strategist and now friend from RBC days. He's been on the show many times. He's got about 50 years of experience. He speaks about the interest rate environment. And in America, he sees long rates actually going higher, and I agree with him. I do think the 30-year, 20-year will actually ultimately push higher than it is. Right now it's rolling over, which is good for the market, help price rate cut, but ultimately higher. Short rates lower. Question is how much. So here in Canada, interest rates have a lot of room to fall, maybe 1% or 1.5%. In America, not the case. I don't see much more than a full percentage point cut over time, but we'll see. Calling interest rates, good luck. The central bank couldn't call interest rate expectations, so how can I? But we have an opinion. We need to have an opinion to structure our theses around how we're managing money.
Just to add in there, after today's jobs report, the probability that the market's pricing in a cut now is 100%. Market doesn't always get it right, but that's what it's pricing. And there is potential talk of a 50 basis point cut now. I don't think it'll come in, no. But that's the narrative right now, just because of the weakness on the jobs report.
So interest rates getting cut in September in the United States. Canada already has lowered interest rates twice. So there's your slide deck. I want to go through the performance of the accounts. As of yesterday's close, market's down today, unfortunately. We've got a bit of a washout going on here. We can't fret. Growth account year to date, net of fees is up 5.5%. You can see the monthly, this is net of fees. So anyone in growth, this is basically your return since January, 12 years of data. So you see the annual returns. You see the accounts falling every 3-4 years, and you see the long-term results. This account long-term compounding net of fees at 11%. That's a growth mandate. There is the statistics on the growth mandate. Here's our benchmarks. Here's our performance. 1-year, 3-year, 5-year results. By the way, I just looked at some data from CIBC. 25-year growth portfolio returns is about 7.5%. 10-year results for a growth portfolio on average is about 9%. So I'm very pleased that we've outperformed that. 3-year performance for a growth portfolio is about 7%. We're coming in at about that number net of fees. Again, there's our benchmark down below. As you see, beating benchmark. And we all want to make money. I want to make money. The question is how much risk do we want to take and to what degree? So here's the market performance or the benchmark performance. Here's the portfolio performance going through it on a yearly basis. So even this year, benchmark up, but 6.5% we're up. Net of fees collapsed to, well, I showed you the numbers on the previous page. That's showing 8 to take up a little bit for the most recent action. Here's our S&P strategy. So again, if you focus on the S&P, this is the strategy to put your money into. It's benchmarked against the S&P 500. I may change that to an equal weight because this is an equal weight portfolio. The S&P 500 is not. So it's not a pure apple-to-apple comparison, but the S&P 500 is what gets all the attention. So if you want to try to beat that, this is the puppy to play with. And I'm very pleased with the way it's working. And there's no fait accompli, there's no silver bullet, it's probabilities. There's the S&P performance against benchmark. Here's our TSX portfolio. So again, if you want to play TSX, beat the TSX, this is the portfolio. It's a 15 stock portfolio, doing very well. You see the market rolls, it rolls. It's nothing goes in a straight line, unfortunately. This is the balanced portfolio. So this one again has 20 to 25% in bonds. The bond should be finally helping the portfolio with interest rates pulling back. The bond managers are very strategic, very tactical in how they manage bonds. Jack pays a lot of attention to the bond managers. It will not excite you, the discussion, and it'll probably make your eyes glaze over as to what they are trying to do but they're basically looking for dislocations and waiting for dislocations in the bond market, the debt market, and at which point they want to act. So they're not making per se interest rate calls. They're rather waiting for dislocation, sitting safe right now, earning about a 5.5% annual return, which is sort of the job of them to do. PIMCO, for example, up about 7% last 12 months, not bad. So that's 20% in bonds, the rest in equity. There's the performance for it. The 1 year, 3 year, 5 year, 10 year. There's the benchmark, performance benchmark, and we put the TSX in it, even though it's not, it's not a TSX portfolio, it's a balanced portfolio. And here's a conservative portfolio. It's actually beating the balanced portfolio and neck and neck with the growth because of its bond position and less equity. So it's a 50-50 bond stock portfolio. And there is the performance of it. And again, long-term, this portfolio is trying to beat T-bill. T-bills generate 5%. This portfolio is basically beating T-bill, 7 years, 5 years. Even the last 3 years, you couldn't get 3.5 on T-bill. Maybe last 2 years, so 3 years it lagged a little bit. What do you do? It's a conservative portfolio with some good dividend interest in it as well. So we are here in the middle of a corrected phase. I do want to go through a few charts with you just to show you the tape action of the names that we do own. I don't want to bore you with this, but understanding what you own gives you knowledge. So when you forget about the market, pay attention to what you own and are invested in. Again, we own about 50 stocks, about 2% weighting in each stock, some 4% weighting, some 1% weighting, but we own about 50 stocks. They're all good quality companies. The question is, does the market want them all today? So we own with Colgate. Yeah, I used some this morning. I think, Jack, did you?
I did.
Thank God. We own Colgate, nice clean chart, boring company. Celestica, Canadian electronic manufacturers. You see how quickly these things can trade off. It has not broken trend. It is down from peak, and it hurts all of us. I own it, you own it, and trust me, your account's down, my account's down. I'm not a happy camper today, but I'm staying very calm. I am rattled, not stirred. Stirred, not rattled. I don't know what happened.
Shaken, not stirred.
Shaken, not stirred. Yeah. Celestica. So here's an oil stock. I sold it in the quant strategy. Down at the bottom, not breaking trend. That's good. Meandering. I don't know what kind of winter we're going to have. Oil is oil. We have a smidge of it. You want to have a smidge of it at least, so when it wakes up, you get to participate. We don't own any gold. That's been a real winner on Bay Street. I don't like gold. I don't like gold miners. Their long-term success rate is terrible. It's having a great move. I'm not there. I just can't get my head around it. So I can't be at everything if I don't have the mental aptitude and justification to own something. Costco stock was 900. Now it's 800. Nothing's changed at Costco other than they are going to raise their membership fees. I know Kathleen went to Costco to get, not fact, went there to get some half and half cream because it's $2.69, and she came out spending $200. Costco. Carlisle, it's a building stock, building wraps and the like. Great business, trades at 10 times earnings. Stock was $4.40, it's $3.90. Nothing is wrong with the company. Market's just rotating. It's doing a little selling here. On trend. These things turn, they turn. You see when they break, they turn. As the stock was 230, it rips to $400 from November to May. When they turn, they turn. Unfortunately, we're in that corrective phase. We're in this phase right now. I don't like it. It is the price to pay. Stocks yield double the return of bonds. To get that return, you have to accept the volatility. I have to accept it. You have to accept it. It's not fun, but it is rewarding. Constellation Software, it is a go-to stock on Bay Street. It's a consolidator of software companies. The excellent management team is doing a great job. Very accretive cash flow when it makes acquisitions. But again, the market knocks it down, because it needs to sell something to buy something else. Nothing wrong with the business. It will continue to push higher. Cintas, nice clean company of uniforms. We own it. Insurance stock, you're probably a customer. Flirting with all-time highs. I'll take that. Home builder, I don't like home builders. I'm afraid of them, but they're working. I can't fight it. I cannot fight stuff that's working, especially if it's hit my quants. Excellent tech stock in Canada. Again, it was 140, it's 130. You see, even good quality business can take a little shakedown, but nothing wrong with the business. Eaton, it just broke the 200. That's a bit of technical damage it's done. But again, it is a fantastic smart energy company. That's how they're in that position, is smart energy. Artificial intelligence is using power. EV is using power. Crypto is using power. We want to go off oil. You need more electrification. They get them all excited. They have to pull them back every now and then to reset the deck. We have a position in it. Pays the dividend. It makes money. It's a real business. You want to see the 10-year chart of this stock? It might help us. So the long term, the trend is your friend. We all know that. So there's a trend of this company here, but it has these periods of time. Unfortunately, we're in this right now. If we leave it alone, you'll end up with something like that to that. Stock was $65 2 years ago. It's in play. It's working. Now it's $300. So if it pulls back to 250, I wouldn't be surprised the stock to get to 500 down the road. This market is going higher. It is a bull market. It's just in a bit of a cyclical corrective adjustment phase. Energy services stock, it just hit my quant screen's top of the list. A bit of a must own in that respect. Fairfax Financial Insurance leader, mini Warren Buffett, Prem Watson, Tycoon, or whatever you want to call it. A very successful man, shall I say, on Bay Street. Stock's holding very, very well. Have some of that. This one continues to push our super expensive credit scores, your FICO score. Clean chart. Google, corrective phase, 190 down to 160, like poop through a goose. Trust me, you'll be using it this weekend. We're all using Google. It's an advertising machine. Company does about 15 to 20% growth annual, spending a lot of money on AI because it has to. That will affect its earnings. But I want to own leaders. If I'm going to own tech, Microsoft, Google, I want to be in that. Again, we do run, by the way, blue chip portfolios. We have to remember that. Small caps woke up. We can put some in, certainly in the growth mandate. The small caps will never make the S&P strategy because it's an S&P strategy. So we have to be conscious of that. But know that when you sell a blue chip and you go to a small cap, you are taking on more risk. Now, that said, depends on the price you sell and the price you buy. And that's why the market is rotating. Small caps became oversold. They became too cheap. And so money has moved there and continues to today. IWM would be the stock to look at. And actually, small caps down 4% today. Wow. We're getting killed. Goldman Sachs, blue chip financial. Ontario Hydro, all-time highs. We own a bit of that. Tech, so Hudbay Minerals, copper stock, copper electrification, holding trend line corrected. Nothing wrong with the business. Installed building products, again, building materials, construction, is fine. Just, you see the way these things trade. Another insurance stock in Canada, the largest insurance provider, nothing wrong with it. Oil stock, sideways, nothing wrong with it. Ingersoll Rand, it's industrial equipment, pressure pumps, sideways, nothing wrong with it. Just doesn't unfortunately go up every. Iron Mountains, the paper shredding company. Who would have thought? Seems making new highs. So that looks good. Intuitive Surgical, it's robotic surgery, state of the art. It's healthcare. I said we want healthcare, so we own McKesson, we own Intuitive Surgical, and we own McKesson. McKesson, Isrig, and there's a third, Jack. Two. Let's look at a third. Oh, we're looking at HCA. Yes, we own two healthcare, so we need a couple more. JP Morgan, a little pullback. Private equity, nothing wrong with it. Semiconductor stock, equipment, making equipment, 890 down to 690. Huge correction. Now, it's getting somewhere. That's a big correction. So I do not want to sell the stock down here. I need to keep some semis. AI is not going away. The world does need semis. Onshoring, political rhetoric, part of the stress. It'll pass. HVAC, Lennox, nothing wrong with it. Weight loss drugs. So yeah, that's the third healthcare stock. Lilly. Yeah, so McKesson, Lilly, and Intuitive we own. Lilly's had an amazing move. I continue to hit my quants. I reluctantly bought it back. It's still on trend. I do think it's better than Novo Nordisk, although there's McKesson, the other healthcare stock. Insurance stock, financial stock, Microsoft. So again, blue chip granddaddy. Honestly, this is where the stock should be purchased, not sold. So yeah, we just endured a lot of pain. 15% Microsoft, a granddaddy of tech companies. And just to whet our appetite, Microsoft, and I can do the same with Google and Apple. Right now it's rotating, I know that. It's a $3 trillion company. So how much has come out of it? 15%. So $450 billion already came out of that company, right, Doc? Yeah, $450 billion already came out of that company and went elsewhere. But Microsoft, their revenue, in last year, 2 years ago, $198 billion, generating $65 billion of free cash flow. In 2023, cash flow dropped to $59 billion. Revenue rose. Now cash flow on 24 came in at $74 billion, and it's estimated to be 75 billion next year and 92 billion in 26 and 116 billion in 27. Free cash flow, a lot of fajolies. This is you don't sell it down here. You just don't. We're holding Microsoft. Gas stations, believe it or not, in the United States, so 1,700 gas stations. Look at the chart. Boring. Pays us a dividend. It's like Couche-Tard. We own Couche. We traded Couche, made money, and now we own Murphy's. There's Netflix pullback. I like Netflix. We all use it. Trend on, fine. NVIDIA is a big semiconductor darling. It has not broken trend. But boy, what a correction from 140 to 100. Morgan Stanley just put it back on their top buy list because of corrective phase, because it's down in valuation. It may fall another, it may break the 100. I don't know. That is an important number. It's called par. So far, it's held par. It's 103. $80 is the line in the sand on it. And it's going to be reporting results imminently. Hopefully the correction is pretty much behind us. Pan American Silver, so we don't own gold, we do own Pan American Silver. I'm sure they got some gold in their veins and some copper as well, but it is primarily a silver producer. Just because networking equipment for the cloud, is it cloud and security, Paul?
Security, yeah.
Security, yeah. Insurance stock in the United States, blue chip. Another home builder, so we have two of them. Pipeline in Canada, dividend payer, 5%, trending nicely. Royal Bank, even that 145, 150, down 6% in 2 days, bang, bang. AT&T, big dividend payer. That is pushing nicely for us. It's a cheap stock. Tech Resources, on trend, corrective, has lots of cash, just sold some coal assets, has gobs of cash on its balance sheet. We may get a special dividend on it, and or they're going to buy some more copper assets. Good management team, good balance sheet. And again, I do like copper. I can buy into copper more than I can buy into gold. And it's not working, by the way. Train, HVAC company, heating and air, smart, energy efficient, use less energy, modernize, higher building standards. That's the theme around it. It's a very, very good quality business. Great return on equity on these companies, by the way, which is a key factor. Trade Desk. This one's interesting. Again, it was $102. It's $82, already down 20%. It's media trading. Again, I used to be a media sales rep. We used to go to big agency buying houses, and 28 reps would sit in front of a buyer who would have a piece of paper and a spreadsheet and scribble down how many spots they would buy and put it into some cheap software that was supposed to tell you how many people were listening to the radio station and how much per thousand they were paying for each person that they were communicating to. TDS, very, very inefficient. Well, come along digital media, throw in some software and some computing power. All the digital media now can be traded through via software, and the software company gets paid juicy amounts without having all the staff to pay for. So if you want to buy new media, you want to buy digital, Trade Desk is the champion and leader. I like the space an awful lot. A bit of a, not lunatic fringe, but a bit of an esoteric name. It's a $40 billion business. It's a real business. Unfortunately, it pulled back a little bit. So again, we'll see. I own it. I can sell it tomorrow. No, I can't. Saturday. Sell it Monday if I want to. No, I can't. It's a holiday. Sell on Tuesday. US open on Monday?
It is.
Yeah, we're closed Monday. So that's going to be interesting. United Rentals, rental business. I flirted with the stock a number of times. It's a bit frustrating for me. I like the company an awful lot. You just got to buy it at the right time. And truth be told, this stock here, the right time to buy it is not when it's up, which I did. You want to buy this name when it's down, which I did. It happens. Some stocks, I like buying strong stocks because they tend to go higher. But some of these old industrials, the valuation is a lot more insensitive to them. You buy them sort of when they pew, and you have a chance to make outsized money. Again, easy said, hard to do. Waste Connections, Canadian garbage company. I fought with this name forever. I just purchased it recently in the TSX portfolio. It's a very expensive stock. It's at 55 times earnings, but they basically have a landlock on garbage. It's secondary markets where there's no competition, good gross margins. Basically, they are a price setter. So it's a very interesting business. It's a good business in the United States. It's a good business in Canada. We also look at Waste Management and Progressive, Republic Service, sorry, two U.S. names I really like. Toronto Stock Exchange, holding in okay, and Apple. So that is what we own. That is the backdrop. Market's getting absolutely creamed right now. I apologize for that. I cannot control what the market is doing. This is our reaction to it. This will end. I promise you, my friends, this corrective phase will end. When, I don't know. And to what degree, I don't know. But we're here every day, paying attention every day, and dealing with what we need to deal with. And doing nothing, which I'm doing today, is doing something. What's it said? Because anything we can do for you, let us know. Any questions, concerns, we're here for you. And on that note, I do want to wish you a great long weekend. And I'm sure we'll speak with you one way or another next week. Thank you.